Do you ever wonder how much money your business will actually bring in the next month, next quarter, or even next year? That's where revenue forecasting comes in. Revenue forecasting is simply estimating how much money your business will earn in the future. And the good news, you don't need to have a finance degree to do it. Welcome back to the channel. If you're new here, I'm Joe, a licensed, certified public accountant with over 10 years experience in corporate and public accounting. I have an extensive background in accounting, audits, and taxes, and I'm all about helping you take control of your money and live smarter. Be sure to subscribe to the YouTube channel and turn on all notifications. And don't forget to check out our blog site where we post every Monday, Wednesday, and Friday. In this video, I'll walk you through a simple step-by-step process to forecast your business revenues, so you can plan smarter, make confident decisions, and avoid cash flow surprises. Let's start with a good definition of what revenue forecasting really is. Revenue forecasting is about predicting future income so you can make better business decisions, such as whether to invest in your business in a new piece of equipment, whether to pay down debt, whether to expand, or whether you should hire more employees. Helping to forecast a revenue tells you how much money your business will earn. It'll help you to plan for cash flow, and it'll also help you to avoid surprises. Step one is to look at your historical sales data. If you've been in business for a while, your past revenue is your best guide. We're going to want to review the last 6 to 12 months of sales. This is to give us a good window of projection of where we may be at. We're going to want to identify trends, like if there's seasonal spikes and when there are slower months. And then we're going to want to check whether our business is growing steadily or if we're fluctuating. If your business doesn't, if your business is new, don't worry. You can skip this and focus on realistic estimates based on research. Instead of guessing total revenue, break it down by product or services. List each product or services that you provide. Estimate the number of units you think you'll sell. Multiply it by the price. For example, let's say you have service A and you think you'll do 50 sessions and you charge $100. That's $5,000 in revenue. And then you have a product B that you also have, and you think you're going to sell about 20 units at 50 bucks a pop. That's about $1,000. So your total revenue forecast is $6,000. Breaking it down like this means your forecast is more accurate and easier to tweak. Most businesses have busy and slow seasons. For example, in my services, our busiest season is usually from January till about April. And then it slows down from about April until we'll say about August. And then it picks up again from August until about November. You just got to find yours. Retail, if you're working in that, if that's your business, might have peaked during holiday seasons. This is when most consumers do a lot of their shopping. And then you have a slowdown period during that first quarter from January until about maybe March, just depending on the type of retail business that you are. And then you have service based businesses. They might have seasonal demands as well. For example, as a tax preparer and an auditor, our busiest time is really from January until about mid April. We're burning the midnight candlestick during that time period. You want to look at your industry trends and your local events that affect your sales. If December is always your best month, you might want to increase your forecast for December and lower for the slow months. It may be tempting to be optimistic in your revenue forecasting, but be realistic. Remember to keep this term handy, conservatism. That's what we use in accounting. We want to be conservative about our forecasting. Remember, remain realistic and not overly optimistic. Use conservative numbers for new products or untested ideas. Plan for a 10 to 20% lower revenue than your best case scenario. It's easy to adjust upward if sales exceed expectation than to deal with disappointment from overestimating. Your forecast is not a set it and forget it plan. Be sure to review your revenue forecast monthly or quarterly. Remember, don't forget to compare your estimates to actual results. This will help you to adjust for new trends, customer behaviors, or market changes. Don't forget to regularly update to help keep your business agile, and it helps to make smarter decisions. Once you have a revenue forecast, it's a powerful tool. Once you have your forecasting, you can make certain decisions like planning cash flow to make sure bills are covered, decide when to hire or invest in new equipment, set realistic growth and marketing goals. A forecast gives clarity and confidence for your business planning. Revenue forecasting doesn't need to be complicated. Start with what you know, break it down, account for the trends, be realistic, and update regularly. Remember, even a simple revenue forecast can help you to avoid cash flow surprises, plan smarter for the future, and grow your business with confidence. Doing these things and making sure you're going back and updating it regularly will help you stay ahead and keep you stress free. Start forecasting your revenue today. Even a rough estimate is better than none. If this video helped you, hit the like button, subscribe, and share it with other small business owners. Take control of your business finances, one number at a time. Next week, we will talk about accounting mistakes to avoid.